Welcome, everyone. I'm Angelo Robles, and welcome to Family Office TV, and especially my members at SFO Continuity that get the opportunity to be live to these webinar formats and specifically to interact with questions. Today, Utopia or Dystopia, how to invest through 2029, we're going to get to that, amid elections, war, AI, dollar decline, and goal surges. It features a special guest we've had on before, one of our most popular guests ever. That would be David Hunter, who's a contrarian macro strategist with over 50 years of experience on Wall Street. As we approach not only the end of this decade, and I know that seems a little, Angelo, you're jumping the gun, but lots is going to happen. And progressing into the next decade, there's an unprecedented economic and geopolitical challenges that are at our doorstep. In this special podcast, again, I'm joined by David Hunter, a seasoned macro strategist with, as mentioned, over 5 decades of experience. And we're going to explore how family offices and really investors in general can navigate what's going to be, and I certainly agree, a very turbulent landscape. David, welcome back to the show.
Angelo, great to see you.
Okay, we have a lot to get to, so let's do it.
Sure.
Do you still believe the last time I interviewed you, summer of 2023, that we were going to enter into a significant melt-up, followed by a massive market crash around, at that time, 2029? What has changed with your perspective in the last 15 months?
Yeah, my perspective hasn't changed much. I'd have to correct you a bit. On the 1929 or 2029 is not where I saw the crash. I saw the crash following the melt-up. The melt-up's taken longer. I mean, I thought this could have happened a year ago. It's stretched out. I think you'll see the top in this market potentially this year, and then a meltdown, or what I call a global deflationary bust, likely next year. And then the balance of, and I think it gets contained pretty much within a year, so it might be 12 to 15 months, but it'll be, as I say, I define a bust as something that feels like a depression, is greater than a recession, but happens at the speed of a recession. So more like a 12 to 18 month time frame instead of something that stretches out over a decade. So that has always been my view, that the melt-up was, right in front of us, and then a golden bust would follow very shortly thereafter. The balance of the decade, let's say we finish the global bust next year or early in 2026, the balance of the decade, I think, is going to be, and we can talk, we'll go at length to explain why, will be a super cycle for commodities. There'll be an inflation-driven industrial recovery cycle, probably lasting late this decade, early next. And then I think, which may have been why there was some confusion in time, I believe in the 2030s, I'd say probably 2033 to 35, somewhere in there, but it could be sooner. I think we'll see a much bigger collapse of the entire global financial system. So that may have been what you heard, but I've always had this global bust, which I define as something bigger than 2008-9, as hitting us, right after the melt-up.
Okay, I mean, with the issue with wars going on around the world, with geopolitical challenges, with massive election issues and challenges here in the U.S., that's a scary scenario. It's not 100 years ago. I think it's a more volatile world in many ways. And to think that it's going to be maybe not as bad as a depression, but worse than simply a recession, and then maybe get better and then get really bad, is not exactly something that is warming my heart. But at the end of the day, investors and family offices need to be aware of scenarios that could happen and how they could either, quote unquote, hedge risk and profit, assuming we have a country and a world left. And my audience, I promise, and you probably know me by now, we will definitely intertwine geopolitics and a lot of those issues in my conversation with David, so just stay tuned. David, I ask anyone who has strong opinions with this, and you are not necessarily incorrect on the melt-up, the markets, broadly speaking, have been quote unquote attractive. Maybe not a pure melt up in the grand scheme of things, but certainly an attractive market for the most part. But my core question, rather bluntly and with all due respect, could you be mistaken?
Well, I would say we've had close to a melt up already. The NASDAQ's up 80% in 2 years, less than 2 years. The S&P is up 60% plus in that time frame. So from 3,500 on the S&P back in October of 2022, we've had this run to 5650 area on the S&P, and I believe my targets are S&P 7,000. As I said, I think we'll get there this year. It could spill over. The calendar doesn't matter, but I think it could be this year. And NASDAQ 24,000. I've had a target of the Dow. I had a target of 48,000. I've raised that in recent months to 55,000. And the Russell, which has been the laggard in the markets, I have a target of 3,300, which is 50% from here. So I would just say, we're in. I think the parabolic part of the melt up is still ahead. I think we may start it as early as this week, but give it a little space here, and I think you'll see what I mean by parabolic. I think this thing's going to get steeper.
Of course. So your opinion from the last time I had a conversation with you is relatively the same, if anything, perhaps more intensified on the downside. And we're going to get to some of those reasons why. You're extremely confident. It's just a matter of timeline, and that is something, I guess, that none of us control. What is your current, I don't know if you wanted to grade it on a scale of 1 to 10, what is your current level of conviction relative to speeding up the timeline of something between a recession and a depression?
My conviction I'll put it this way, my conviction on the melt up and is as high as it can be.
Wow.
And I have, as you know, from October 2022, the vast majority of institutional investors fought that market all the way up, thought it was a bear market rally until we got to new highs. So all the way from 3,500 to basically 5,000, there's been a battle where people said, yeah, it can rally, but it's going to roll 3,500. They thought it'd roll over at 38 or 900. Once it got above 4,300, they said, well, maybe it's got legs to 4,600. Then it corrected 4,100, and they were sure that was the next leg down to new lows. It turned at 4,100 or thereabouts, and then went up to the present levels here. And I would argue, and as you know, most Wall Street strategists have forecasted for end of this year numbers close to where we are. Some are below today's level, some are slightly above it, but they're not looking for more than a couple hundred more points. I think in most cases there may be a stray 6,000 target out there, but I had a target of 6,000 when the market was 3,500. 2 years ago, I raised it 7,000. Then I moved it to 6,000 to 7,000 sometime last year. Later part of last year. In January, I went to a full 7,000 target, no range, and I've stuck with that since. I actually think my 7,000 target on the S&P is probably going to prove to be conservative. So that's a crazy thing to say from where we are now. You're looking at 30% upside maybe, and perhaps more. And the NASDAQ more than that. The Russell, as I said, 50%. So my conviction on the melt up is high. The global bust, my convictions are high that we're going to have a bad economy next year and a bear market. Whether it reaches my levels of a global bust, which I define as something worse than 2008-9, and an 80% bear market, which is my forecast, whether we reach quite that much, who knows? But my convictions are pretty high for that. But I can't say they're anywhere where I can say through the roof. But I think it's a high conviction call for me, and the reason and to try to explain the bust. I argued that in 2008-9, if you remember fall of 2008, we almost lost GE. The commercial paper market froze up. GE was very dependent on commercial paper. We were very close to a so-called meltdown then or a bust. They pulled us back from the cliff. They freed up the commercial paper market. They saved the money market fund and said, we're not going to break a buck. They did some things pretty quickly in the fall of 2008 to save the system, and we didn't go through the bust. What I call a bust is that next step that we almost got then. So I think because we are so much more leveraged than we were even in 2008-9,
Yes.
you turn an ordinary recession or even a bad recession into something worse. That's basically my thesis, is that you have a combination of three things. You have fragility in the economy, both here and abroad, because of the pandemic. And some of that gets covered up because we've had this recovery and statistically it looks okay. But under the surface, there's a lot of fragility that happened because of what happened during the pandemic. So you have fragility of the economy. On top of that, you have this massive leverage of $320 trillion in global debt, quadrillions in notional value of derivatives. And as I say, derivatives are the leverage on the markets. Debt is leverage on the system. So you have a kind of double whammy in leverage, way beyond anything we've ever had going into a downturn before. And when I add the fragility in the system and then on top of that, I'll focus on the Fed, but you could probably say the same thing for most of the central banks. They're fighting the last war. They're still worried that inflation is going to break out. So they've been very slow to ease, even though under the surface you can see all the signs that we're heading into recession if we're not already in one. When the NBER, the National Bureau of Economic Research, dates a recession, and I've been watching that for 50 years, it almost always starts before you thought it did. So I would not be surprised if we're in recession now. And yet the Fed is sitting there kind of twiddling their thumbs saying, well, we don't want to ease prematurely. Well, we've got inflation down, but we don't want it to reignite. They're fighting the last war as a result. And frankly, in my opinion, and this is true of most FOMCs, but this current one, they give lip service to leads and lags. But when you listen to their rhetoric and you watch them, they don't really understand how much of a lag there is to their policy. So they're focused on the present. They're looking at data that's backward looking, and they're thinking they can kind of take this right to the edge and ease right on time. I think they're way past that time already. So if they've overstayed their welcome on the tight side and you have the leverage you have, to me, it's a prescription for a bust.
Okay, I'm going to go back to kind of my follow-up question to my original question and push it just a little bit. What precisely would you need to see going forward that, although you believe your long-term prediction is going to be accurate, timelines may change? Let me give you an example. Apparently, per Elizabeth Warren, tomorrow, which is September 18th, they lower interest rates by 75 basis points. Let's make the assumption Trump wins. Let's make the assumption they print more money. That could potentially timeline cause more of a quote-unquote melt-up, but inevitably, in your opinion, the downturn, whether it's now, 6 months, 12 months, it's coming, and it's not going to be 5 or 6 years from now.
I certainly agree with that statement. Number one, I don't think, I think it's 25 or 50, and I have been saying for a couple of weeks, maybe even longer, it's going to be 50, or that my bet is it's 50, because they are so far behind the market in terms of rates, and inflation has gotten down almost to their levels. So there's really no reason for them not to go 50. And it's not because they're panicking and saying things are looking worse. It's because they're recognizing that their policy is far more restrictive relative to market rates than it should be. They're 200 basis points behind the market. So why would they do 25, And so I think tomorrow is pretty much I'd be surprised if it's not 50. They're not going to go to 75. There are still people on that committee wanting it to be 25. So I think they're gonna be happy with 50. But and then I think I think Powell will signal that we could get another at least another 75 basis points, maybe another 100 basis points between now and the end of the year, 50-50 or 25-50 after this 50. So, to me, the thing that people should be focused on and why I think this melt up happens, and I keep, I'm on Twitter all the time or on X, and I am constantly telling people I'm not hyper focused on tomorrow's meeting. And I've been saying this for weeks because because the easing has already occurred. We had a 10-year at 5%, 6 months ago or 8 months ago, whenever it was. We're down to 365. So it's eased to 135 basis points already. Mortgage rates are already coming down quite dramatically. Car loan rates are coming down. So everybody thinks it's the Fed that sets rates. No, the Fed sets the banking overnight rate. That's it. And yes, some things get priced off of that, but an awful lot more gets priced off the 10-year. So the easing is being done already, whether Powell realizes it or not. Financial conditions are easing. So even if they did the wrong thing tomorrow and did a quarter, the bond market's going to just take rates lower. So it's not that the Fed's irrelevant, but they aren't as important as people make them out to be. And the more important thing is I think Powell is on board and his committee is on board now. It took them a long time to recognize the easing cycle is beginning. Tomorrow sets the beginning of the easing cycle. We haven't had a rate cut in over 4 years. We've been tightening for 2.5 years. It's a big deal when they start easing. And I know the chart that's out there that says when the Fed starts cutting rates, that it's time to sell your stocks. That's bogus. It's true that in the last couple of cycles that may have been the case because we had bad economies coming right away, and it was not so much the Fed cutting as it was the market recognizing things were in trouble. So this time around, we don't have that. I mean, I am calling for a bust, so we will have that. But right now, it looks like soft landing. So I don't think you react to a rate cut the way people think think the market will.
Good points, David. And David does have a significant audience, and some of them are going to be newer to me. I have interviewed David several times. I actually watched also some of your recent interviews. So for your audience, which is substantial, I promise you, I will have questions that David has not been asked yet around the election, around societal issues, which will be a little bit unique in geopolitics, and weaving that in to macro strategy and investing. So just be a little patient. I do long-form interviews, and building a story sometimes is important. David, how do you know what information that the Fed publishes is useful for you and investors, and what is fluff and not of value at all?
Yeah, I mean, I don't think that it's so much what the Fed, the Fed certainly publishes their money figures and all.
Sure.
And I consider that important to look at. And, they're looking at all kinds of data that doesn't get published. I think I try to explain to people it's trends that are important, not data points. So, people focus on a CPI that has a 0.1% higher number than expectations, and people get hot and bothered and say, "Oh my goodness, CPI is not in as good a shape as we thought." And I go, that doesn't matter, So I don't spend a lot of time with data on a month-to-month basis. I'm looking at trends, and I think what you're getting across the board pretty consistently is that you had a weak manufacturing sector and a somewhat stronger service sector that was keeping us above water. And even the service sector, I think, is slowing. I look at things that I think are more leading indicators, such as delinquencies on loans, delinquencies on credit cards, et cetera. When you're seeing that stuff, that tells you what's going to happen down the road. And we're definitely seeing what you have seen at the beginnings of recessions past, where you're beginning to see where the consumer's getting in trouble. And that's happening, and that's why I talk about fragility. That's happening despite, not that many years ago, we had savings at levels we'd never seen, because they were handing people money in the pandemic. They've drawn all that savings down now. So there's no more savings.
They did that probably on the first day they got it.
But
yeah.
Well, the numbers tell you that it took a while, but they have gotten it down now where that's all gone. And they're borrowing money to buy groceries. As we know, there's a have and have not economy, and the have nots, the bottom 50% of the economy, are struggling. The top 50%, certainly the top 10 or 20%, are doing great because you got a market at all-time highs, and you've got real estate in this country anyway at all-time highs, or not far off the highs now. And so their wealth is in pretty good shape. But the people that don't have a lot of investment are struggling.
Right. And their vote counts every bit as much. They're probably more organized than ever before. And of course, it's a sad situation. It's terrible. But to assume that it could continue as it is when people are spending sometimes 40% of their net income on food, let alone on expenditures for rent, for mortgage to live, it's asking for trouble. And all things we'll kind of get into in our conversation, a little bit on a similar theme, and you hinted at it with trends and some of the things you look at like delinquencies. What 3 economic indicators do you look at the most? Do you look at jobs reports? Do you look at mortgage rates? Do you look at TSA check-ins with people traveling? So you mentioned 1, delinquencies. What would be maybe 2 other indicators that you like?
Yeah, it's funny because I don't spend a lot of time thinking about that. Like I said, I'm looking at trends. I'm not looking at any particular things. I guess I look at, ISM to give me some measure of, purchasing manager. Where are they on a month-to-month basis? Where is it? Where's the trend going there? I'm not a big jobs person. I can more tell you what I don't look at. I do not spend a lot of time on monthly jobs numbers. I do realize.
You think they're manipulated?
Oh, sure. well, if they're not, let's put it this way: if they're not deliberately manipulated, they're not. The surveys are not very consistent, and there's they use this birth-death adjustment so that and you get this big adjustment down the road, and you go, well, what do we count on number? We're measuring these numbers as if they're precise, and then all of a sudden you can adjust it by 800,000 people, or jobs. So it is hard to put faith in something like that. But
of course,
I'm not saying jobs aren't important. My problem is jobs are a lag. So to have the Fed using that as one of the things it's looking at for current policy, I think is nonsense.
It's a matter of time. It's just a timeline issue where U.S. dollar dominance it's already waning over the last couple of years and decade. We would call that U.S. dollar hegemony. Whoever rules the world in terms of the dollar, and the U.S. will protect that at all cost, but it's getting lesser and lesser. Therefore, there's more challenges from BRICS, and broadly from China, combination China and Russia, perhaps Saudi Arabia, and perhaps even a future basket of securities. We're maybe, debatably, able to manage our wicked deficit in the fact that the world settles in dollars, but that percentage is decreasing all the time. I'm afraid to ask, but how do you think that will end, and when will it end? It still may take decades.
Yeah, I think people, as you know, the Austrian school, I haven't seen them as much lately, but for a long time, they were really predicting the death of the dollar and the death of central banking, etc. And I just said, it's going to take a lot longer than you guys think. And certainly we're seeing the dollar lose some of its significance out there, but there's nothing to replace it. And I understand the BRICS are, they're coming up with this gold back, but at least the rumors are they're going to have this gold back currency, etc. you're still dealing with the ones heading the charge there. Russia and China are not exactly countries that people have a lot of faith in terms of their court systems, in terms of their their honesty, etc. So I certainly think they'll trade with it, among themselves, which we've already seen in oil, etc. And try to get away from the dollar some, but the dollar is still the dominant force by a long shot. And I don't see that changing in the next 3 or 4 years. The reason, more than anything, is if I'm right about a global bust next year, and I stress global, everybody's involved in this. Everybody's going to be hit very hard, harder than any time in the post-World War II era. I don't think anybody's going to spend a lot of time on digital currencies or, an alternative to the dollar. They're all going to be doing what they can to hold their systems together. So I think that and then coming out of the bust, let's say it's later in 26, it's going to be 2 or 3 years where they're just digging out from this big hole that's created. So I think at least you've postponed any kind of situation where the dollar loses its reserve currency status in any big way. You've at least pushed out the late this decade.
Okay, then maybe even let's put the crystal ball. Let's look 10 years in the future if it takes that long. And I'm pretty much on board with you. Nothing lasts forever. We're talking about going back to Bretton Woods, 1944. The dollar's had a hell of a run that likely is not going to change, like you said, anytime in the near future. Eventually it will. I don't know if that's 3 years, 50 years, 100 years, but it's inevitable. What will cause the dollar? Slight twist on the question. What will cause the dollar to lose that reserve currency status, if anything?
Yeah, to answer your question, I'm going to back up a little bit and give you my current dollar outlook. My current dollar outlook is that we are about to see the dollar break. Once it breaks 100 on the DXY, you're heading. I have a target of 80. It's not going to happen all in this year, but I think in the next 6 to 9 months, you'll see the dollar down to 80. We're currently just above 100. Took a while. It took longer than I expected for it to finally roll over. It's had a couple counter-turn rallies that have held it up there, but it now looks like it's ready to break. Once it breaks, you'll see it quickly down to the mid-90s and maybe down to 90, and then another leg down after some, counter-trend moves and stuff. So I think by middle of next year, if not sooner, we'll have seen the dollar down to 80, and probably could very much happen sooner than that. In the global bust, I think it will get the typical flight to safety trade. Our country, as much as we look at it as a problematic country right now, we still have, the world still looks at us the place where they can run to hide if chaos breaks out. So I think you'll see a complete reversal from 80, and the dollar will go back above 120 in the bust. So second half of next year, maybe even from the second quarter on next year, it'll be a rally back. And I think it'll be a fairly quick one where you get people, running from everywhere around the globe into the dollar, buying treasuries because they feel the government guarantee is there, and it will be because of the printing press. So I think you'll get the dollar back up above 120. And then I think that's the last hurrah for the dollar. From there, say from sometime in 2026 on, I think the dollar just continues to erode. At some point by the end of the decade, it'll be, I think, down to 50. Maybe. Wow. So I'm not optimistic on the long-term consequences or long-term outlook for the dollar, but I do think it's, you've got to get from here to there first. And what I will say is, and I know I kind of go through these extremes, but the melt up this year is kind of the last hurrah of a 42-year secular bull market. It started in August of 1982. It's been driven by disinflation. We had this inflation move this past few years, caused Fed to tighten and over tighten. So next year you get this 80% bear market and a global bust. When I speak of global bust, I think it's going to be a financial crisis bigger than 2008-9, as I say, I think our banks in the U.S. have some religion because of what happened in 2008-9. They're not nearly as leveraged as they were back then. So our banks aren't nearly as vulnerable as, say, banks in Europe, banks in Canada, banks in Australia, banks over in Asia. So I think more likely some of the triggers for the global bust will be from overseas. But I think at some point in that global bust, we'll see bank failures dominoing across the world. So and so worse than 2008-9, even though it's not worse in the U.S. We'll have plenty of trouble, believe me. But so what happens then is that every central bank in the world, as much as Powell wants to say he's never going to do it again, and the other central banks say they don't want to do it again, we're going to see QE far beyond anything we've ever seen before. So I am forecasting, or it's kind of seat of the pants, but the potential is there for, we did $5 trillion in new QE in 2020 in response to the pandemic. I think to deal with this financial crisis of banks failing all around the world, it's going to take $20 trillion in new money in the Fed, or the expansion of the balance sheet by $20 trillion. And similar proportionally are in every central bank around the world. So it's easy for them to say now, we're not going back there again. We're not going to do what we did the last decade. We're not going to make that mistake again. When they're faced with a financial system that's melting down in front of them, where they have one choice, and that is to prop it back up before it totally disappears, you will see all the money that they can manifest, because that's the only thing that they can move quickly on. Ask Congress to solve the problem of banks failing around the world. They can't. It'll take them deliberations and everything else. The only thing that moves quickly is money. You will see every central bank turn on their printing press like it's never been turned on before. When you get that kind of money, and believe me, they'll be forgetting all about inflation because they'll be faced with deflation next year. And they'll not be worrying about, well, if we print too much money now, 2 years from now, we might have hyperinflation, or might have inflation is heating up. They're going to be saying, we got to deal with the here and now. So they will print money like there's no tomorrow, and I mean worldwide. It will trigger an inflation cycle, probably beginning in 27 and then spiraling up by the end of the decade, such that I think in the U.S., we'll have 25% inflation by the end of the decade or early next. That's what will cause the dollar to go through the floor.
Yes, and you kind of beat me to the punch to some of my upcoming questions, but I'll put a spin on it and we'll dive a little deeper. One of my notes was, so will money printing be the main tool short-term of the U.S. government? You basically answered that as yes. I don't mean to take it dark, but there are wars going on. There are some people, you could argue, that profit and benefit from war. Let's broadly call it deep state. All things we'll get into a little bit more later. But in the short term, relative to the turmoil that you're describing, could you see military, meaning the U.S. military, be involved in a variety of different perspectives to that question on printing money and dollar dominance?
Yeah, so I have to say, it's not part of my forecast. I get here without that. But certainly, how can you not say that that's a possibility? I mean, we have what's going on in Ukraine. We have what's going on in the Middle East. We have the potential of Taiwan at some point in the future. We know that Russia and China are looking at us now as probably more of a paper tiger than ever before. We can no longer fight two simultaneous battles at once. In a lot of ways, we've really watched our military atrophy. So, we got woke stuff going on, et cetera. So I can't say that can't happen, but it's not part of my forecast. I get there without that. And by the way, as much as I talked about the printing press, it's going to be matched by the government. So I'll just again focus on the U.S. If we do $20 trillion in new QE, it will be pretty much matched by new treasury debt. So they'll be monetizing new debt. They'll be buying up every bond they can get, but they'll be, so maybe it'll be, instead of 20, they'll do 50 trillion in new expansion of the government. But they'll be using the money to prop up pension funds that are failing. They'll be using it to prop up banks that are failing because of commercial real estate. They'll be doing it to put money in everybody's pocket. You'll probably see helicopter money. So there'll be all kinds of things that money will be used for. The problem is we've got a $1 trillion interest payment now, annual interest payment on that treasury, 35 trillion in treasury debt. If that grows to something like 50 trillion, and interest rates will follow inflation. If inflation goes to 20 or 25%, the interest rates are going to be going to 15 or 20% or higher. How do you solve an equation to finance? We won't have the money. There's just no way to, now early on in the first couple of years out of the bust, inflation will be coming out of deflation. So initially you got to get back to even. So the first year, you're probably looking at a little single digit, 2, 3, 4% inflation. That's say 26 into early 27. By the end of 27, you could be up to high single digits on the way to double digits. By 28, 29, you're moving towards 15% on the way to 20 or higher. And I'm talking about inflation, but interest rates too. And so, the first couple of years out of the bust, they can play the game, which is a silly game, but they can play the game of creating more debt to service our debt, right? They'll MMT, the old MMT. We can increase debt to infinity. Well, you can't because of inflation. Because once inflation gets to double digits, you have to shut down the printing press. As I say, it's like pouring gasoline in a California forest fire. You take the hose and you say, hey, water's not coming out of this gases. And, you say, but at least it's liquid. No, your forest fire is going to get much worse. Well, that's what's going to happen with money is once you have inflation moving up towards double digit, you can't print more money or it's just going to quickly translate into, so printing money and floating more debt to service the debt, you'll get behind the eight ball real quick on that one. So all of a sudden you get to late this decade, and I don't know how late, 28, 29, 30, you'll get to that point and you'll have no way to fund the military, fund the butter side of our budget, and pay our debt. Our debt payments, servicing the debt, will eat up the entire budget.
Yeah, there's not enough revenue coming in from, I guess, taxation. Not that we want that to be a solution. That's poor government decisions that lead for us to pay more and more taxes. And already, I saw this earlier in the Biden administration when they floated out there taxing on realized capital gains, and people thought that I was an idiot. I'm jumping to assumptions. And then Harris comes out, and it's not going to happen today or tomorrow. I understand that. They're like a boxer. They're softening the body with soft punches to make you more accepting to that idea as the only solution at a point in the future. But we'll save some of the geopolitical stuff for just a little later. So I heard some prognosticators talk about the U.S. won't be able to raise debt. That's wrong. That might be right eventually, but I completely disagree with that. And you hinted at that as well. We might be the one-eyed giant in a land of the blind, and those dynamics with Russia, China, and BRICS may alter that. We may have a fellow one-eyed giant, and that does appear to be happening related to my BRICS question, which now I think 159 countries are technically on the BRICS payment platform. It's foolish to assume that things aren't changing. And maybe that's why the U.S. is looking to be more militarily active from protecting the dollar being quote-unquote dollar hegemony.
Yeah, I want to go back to the BRICS and the thought that they are in control in any way. Because think about the bust. The bust is going to be hitting. I mean, look at where China's at today. The bust is going to be hitting China. And we're the strong country right now economically, right? We got our problem big time. But we're stronger than Europe. We're stronger than China. We're stronger than Japan's going to run into trouble here pretty soon. We're stronger than Canada. We're stronger than Australia. There's going to come a point in that bust where I don't think, the BRICS are looking at it as, hey, you guys are kind of, running profligate policies where, we're going to be the disciplined countries where, the BRICS are going to have a gold-backed currency. The worst time to introduce a gold-backed currency is when you're about to melt down and you need money, right? I mean, when you take away the printing press, you're in trouble. I mean, we're not going to have anything binding us. It's going to be a problem 2 years later, but we're going to be able to print. They're going to have to abandon some of what they planned. So I would not say they're in a driver's seat situation. They may think they are. They may think they got the prescription right now. Down the road is when I think all this comes back to haunt us. But in the next 2, 3, 4 years, I'm not sure the BRICS understand, because they're going to need money. Everybody's going to be needing money when you've got an implosion of an economy.
David, should U.S. family offices, the wealthiest of the wealthy, be concerned that probably 90% plus of their portfolio is denominated in dollars? How you described it, the next couple of years, not really. But how do they learn to adapt to a changing future?
Yeah, that's a good question. It's going to take, because it's not going to happen in a straight line. So it's going to take them having to got to realize that, yes, we've had it, we've had the good times for, 40 plus years or maybe 80 plus years, but those times are going to be changing. And you may need to worry about hedging the dollar. You may need to, do other things in your portfolio that you may not have done. Now, hedge funds have, but lots of other, long-only funds have not. So they may have to be concerned with that. I think the bigger thing is inflation is going to change how you invest. We've had 40 years here where mostly it's been disinflation. Disinflation benefits growth stocks. Disinflation means PE multiples are rising. Disinflation means index funds actually were the easy place to put your money because they most of the time outperform the active managers that were having a hard time dealing with all this. The next cycle is going to be very much more active management. It's going to be very driven. It's going to be kind of late 70s, early 80s type of environment for stocks where growth isn't the name of the game because interest rates shrink PE multiples and make it tougher for, long-term growth. You're going to have to be in companies and stocks where they have pricing power, where they can outpace hyperinflation. So if inflation is moving at double digits, there are not too many industries out there where you can, certainly not Colgate-Palmolive or, Procter and Gamble or, a grocery store. Those aren't going to be able to keep up with inflation. But if you're in commodities and precious metals, you're going to be able to outstrip inflation. So, I mean, I'm forecasting this. I'm kind of jumping ahead probably, but I'm forecasting $500 a barrel of oil by the time we get to 2030. So, I think we'll see $30 in the bust. So it'll go from 30 to 500. And I've been pretty much the only bear on oil for the last couple of years where I called $60 oil a long time ago. We're above 70 today, but we're heading for 60 and then 30 in the bust, in my opinion. But the next cycle, because of all that money we're printing, is going to ramp up demand for everything, demand for commodities. So commodities across the board, including ag commodities, are going to go through the roof. Natural gas will probably go up to $50 from $1. Um, gold will probably go to 20,000 that's my target for the end of the decade. Silver could go to $500. Copper could go to 20 or higher from, current forward change. So there's going to be big moves in commodities. Meanwhile, all those people who for the last 30 years thought they were geniuses just putting their money in S&P indexes are going to find the indexes can't keep up. The index are going to get hit hard by inflation and higher interest rates. So it's going to be a very different environment to invest in, not just currency-wise, but across the board. And by the way, you can pretty much figure this one out. I think next year, if they're buying every bond in sight and they're printing money at the rates I'm talking, you could see a 0% 10-year. That's actually my forecast for the bust. From there, you could take 0% 10-year and within 5 years be up above 20% or certainly approaching 20%. So bonds will not be an alternative to invest in. As I say, you're going to have to learn the game that I learned back in the late 70s, early 80s, where you just constantly roll treasury bills, every 90 days, every 6 months, you're rolling treasury bills at ever higher rates. You don't want any duration in your portfolios at that point.
Wow, that's a little scorched earth there. Some great comments. All things I had upcoming in questions that in a different variation I'll weave in. So that's a lot there. Why don't we just kind of take a dive into it? Because that happens to be effectively most of my upcoming questions. Will hyperinflation, I'm going to ask it a little differently. It's going to have a little bit of a dystopian tone to it. Will hyperinflation destroy U.S. assets?
Yes. Like I said, there's going to be a commodity super cycle from the end of the bust till probably late this decade, early next. So, you can have prices on commodities like we've never seen, bigger than any commodity cycle we've had. However, for a lot of other things, it's going to be a lot tougher environment for, most normal businesses. And, again, use the early 80s, the late 70s, early 80s as kind of a guide. That wasn't a good time for consumer products companies.
Well, it wasn't.
And by the way, if I'm right about next year's economy and the financial crisis, consumers are not going to be in good shape coming out of that. So, you're not going to see we've had, for 30 or 40 years, we've had a consumer-led economy. What I'm describing after this is an industrial-led economy. We'll be reshoring. We've already started that process, obviously. There'll be a lot more reshoring. So everything will be, the things that demand commodities is what will be out there. What won't be there is let's buy restaurant stocks. Let's buy retailers. Consumer is going to be in a tough place.
It's a plot point, David, but comical to some when I bring up Texas Roadhouse. Of course, a great steakhouse. I love it too when I'm traveling. Their stock has done incredible, broadly speaking, over the last couple of years. A lot of the things that we think, it has to be AI, it has to be deep tech, all cool things that are of value, but you look at some retail stocks, Abercrombie and Fitch, I mentioned Texas Roadhouse, and others that are businesses you don't expect to be high-flying. I think maybe it's adapted this year, but the question used to be, what stock did better, Google since 2004 or Domino's Pizza? The way that I'm asking it, the answer is going to be Domino's Pizza. So, and again, I don't want to make it a stock picking a conversation. Those of you that are interested in that is some of the things I do with my members and other programs. But interesting comments. But what I just said, will hyperinflation destroy U.S. assets? But what's going to happen with non-U.S. assets other than commodities? They're not exactly going to come out of this rosy either. It'll probably be worse.
Yeah, no, I think what I do say is that I think some of the commodity countries, Canada, Australia, Africa, where the commodities are, I think those countries will be in better stead. So the U.S. probably will do okay because, and again, it depends on what administration is in there, but they'll probably, because of our abilities, I think will be still be doing okay. China's a wild card. I don't know what happens with China. If they're obviously struggling now, what happens in the bust? As I have said for a long time, people don't realize, or maybe some people do certainly, so much of the miracle of China was just a huge debt cycle. Now they're paying the piper for that. Their real estate obviously is. And of course, there's a lot more to go there. So I'm not so sure. There was a time when I thought it was almost automatic that, in the late 80s, we took the lead and Japan rolled over. And I said, this time around, we're Japan and China's us. But I'm not so sure about that. I think China may have more problems than we realize, or than I thought. So, there are a lot of questions that we won't be able to answer till we see how countries come through the bust. But
David, one of the things I do for families in their portfolio and non-portfolio, in the portfolio, I look at things like leverage and I look at counterparty risk. They don't want to invest in another Madoff. Are they really getting the returns that are stated? And are the fees what stated? There's lots of different things, as well as the underlying pure counterparty risk. It's always a problem, but during the melt-up, as long as it's not a fraud, they kind of look their other way just a little bit. Yet, a market downturn, those things that I noted, like leverage and counterparty risk, that could... I don't mean to make it a little too over the top here, but I've been consulting families for decades, traveling the world doing so. That could absolutely bring them down. That could be crushing.
Yeah, and I have to say, institutions have not really, there's plenty of exceptions, but institutions have not really had a very good track record of late. They really didn't believe this bull market. I was a pretty lone voice out there talking about going to new highs 2 years ago, and they, like I said, they fought it all the way up. They missed the turn in bonds, and I think they're now bearish on bonds, and I think bonds is a huge upside from here. So they've missed on a lot of things. Almost I don't know, they're so momentum driven. And they really, at turning points, were always looking the wrong way. So we're going to have a lot of turning points here in the next few years. So I'm not sure. People have to be careful. It's we're in a world that's not going to be very forgiving if people are late to the party or make the mistakes that I think they're making.
100% agree. And I hope my members and family offices listen. It's not really related per se to what you bring up, but I'm going to bring it up anyway and how it interplays to the melt up, then the meltdown, so to speak, or rise up, then meltdown. How likely is another market crash going back to our days, October of 1987? Because in today's world, we supposedly have a plunge protection team. We have greater technologies. We could shut off the markets. That doesn't get rid of the underlying problem. It may just delay a more instantaneous crash. Am I wrong?
I don't think so. As I told you, I'm looking for an 80% bear market next year.
Right. It just may not happen in one day.
It's off. Yeah. Yeah. My view is we'll probably, looking at some of our other big bear markets of, certainly 2008, 9, 2002 and 3, going back, the odds are you're going to have, and who knows what it'll be, but the first step down might be, the first leg down might be 30 or 40% or 50%. Then you come back halfway, then you have another leg down, you come back. So it's going to play out over 8 or 9 or 10 months probably. And people are conditioned to think this stuff happens in weeks. And I said, no, it's not going to be some of it. You'll have some big moves in that time, but it's going to play out over time. And yes, we have, these guardrails that can kind of slow things temporarily. But as we've seen before, when you shut it down, you just create more panic. People can't get their money out, so they're lined up at the door. You don't necessarily calm the markets by doing that. So sometimes you do, but lots of times it doesn't work that way. And I think because of derivatives, things can happen more dramatically. Yes, you can hedge with derivatives, but you can also exacerbate things with. So, I'm a believer that we are going to see 80% would be the biggest bear market since 1929. So, I think that's very possible.
You hinted at it earlier. I'm going to dive into it a little deeper now, and it's a sometimes a bit of a sensitive topic for me. Inflation hedge. What is an inflation hedge? It appears to be varying assets depending on various points in time in various scenarios. But nonetheless, people may think gold, they may think oil, copper. Are they truly always a hedge against inflation?
No, I mean, we've seen, gold certainly wasn't a hedge in 2022. You had the inflation breaking out. And what gold worried about? Gold worried about the dollar went through the roof between, March of 2022 and October 2022. So the gold got hit hard, as did silver. So it can be an inflation hedge. And I do think, given my call that silver's going to 500 and gold to 20,000, I think it will be driven to a great extent by the commodity cycle, by commodity inflation. So it can be, but it isn't always. And right now, I have a call for pre-bust. Well, I don't do year-end targets, but pre-bust target, which is probably the next 6 months, 6-7 months. I have a call of 30. I just raised my gold target from 3,000 to 3,400, and I have a silver target of 75. I don't think it's driven by inflation because I think we're actually heading toward and ultimately below 2% inflation in the next 6 to 8 months. What I think it is it going to be driven by that weakness in the dollar. If the dollar plunges from 100 to 80, that will be very beneficial for gold and silver priced in dollar terms. And it also will be driven by, I'm calling for a 2.5% 10-year rate by the end of this year. And as I said, 0% next year, but that'll be during the bust. So that's not going to be a time for gold.
Staying a little bit on the quote-unquote inflation hedge, I think you did hint at it earlier with agriculture, maybe not in the short term, but I would think that farmland, if I'm a significant family that has the resources to be a direct owner and the resources to operate it, assuming the government doesn't take it from you, I would say farmland is an interesting long-term hold for families. Would you agree or disagree?
100% agree. I think of all the real estate going forward, I get this question a lot about housing. People think housing is an inflation hedge, and I go, if my scenario comes true, you're looking at double-digit mortgage rates and ultimately high double-digit mortgage rates being above 15%. I said the price of the house has to be inverse to that because affordability-wise, look what a 7% mortgage did to your monthly payment. Imagine if it's double or triple that. So, and by the way, we did get up to 20% mortgage rates back in the early 80s. So that's not, I think we're going there. So I do not think housing, homeowner, housing is a inflation hedge. The one real estate that I think is, the one area of real estate that I think is farmland. So, and perhaps maybe the areas around farmland, so meaning the grain belt, those areas where the homes aren't as expensive, they may hold up much better because of the farmers doing better, and so the businesses in town are doing better, etc. So it'll be the coast that'll suffer this time. Before it was the Midwest that didn't really get the benefits until recently, and the coast really took off. I think it'll be the inverse of that. We'll see the farm belt do well, and the coast not do so well.
I don't mean to get devious or potentially look at conspiracy theories, and if you want to be, I'm going to be a little careful how I ask the question. but Bill Gates is buying a hell of a lot of farmland. Blackstone, BlackRock, all these giant financial companies broadly in real estate. Okay, maybe they have further insight that I don't have, and like we both agree it's going to be a good investment. I don't like, and again, I represent single-family offices, but one gigantic family and corporate institutions that arguably may represent what we may define as the deep state, buying something that's so integral to us agriculture moving forward.
Yeah, I don't either. I mean, if you just look at what BlackRock did and companies like BlackRock did to the housing, at a time when we have a housing shortage, what did they do? They went out and bought up a bunch of housing. It drove prices up. So, yeah, I think they exacerbated our issues. And I think having somebody like Bill Gates out there buying up farmland, I don't. That's not a warm and fuzzy feeling for me. I know. I do think we've gotten away from, in this country, true free market capitalism. It's much more crony capitalism, and frankly, the haves. I understand why people are pretty frustrated, because the haves have kind of had their way for a long time here.
Indeed. You also hinted at this earlier. Again, you beat me to the punch about 20 minutes ago on a whole bunch of things. Staying on the inflation hedge, are businesses with pricing power a true hedge against inflation? But you're noting it's going to come down to more commodities, but I'm assuming there's going to be some winners in the equity markets.
Yeah, well, commodity. When I say commodities, I mean commodity producers as well. So, a portfolio that has, Freeport McMoran in it, or a steel company in it, or chemical company in it, et cetera. Those are all going to have pricing power, so it's going to translate in earnings and therefore in the stocks. So by all means, I think this, every cycle we have new leadership. The leadership of the last cycle is usually the laggard of the next cycle, because they've done so well. Look at technology the last 20 years. They've done so well that when they get hit, and they're going to go down the 80% like the rest of the market, or a lot of them are, when they start lifting their head, there's so much ownership in those sectors, popular sectors. When they come out of the bust into the next cycle, every time they lift their head, there's distribution. There's people selling those stocks because they're overowned. The Googles, the Amazons, the Netflix, and the NVIDIAs, the Microsofts, et cetera. I'm not saying that some of them will do okay in the next cycle, but as we saw in the early 2000s, they ran up so far and they got so overowned, it took them 10 years to get back, right? I expect that in the next cycle, that the leaders of this cycle, which is tech, healthcare, some of those areas, the growth stocks in general, those are the areas that I think are going to lag the next cycle. And what will lead will be industrial stocks, not just commodities, but also, and the defense industrial stocks. Those stocks I think will do okay. But the ones that will hit the home run, I think, will be energy stocks, the metals, infrastructure plays, in terms of more heavier industry type infrastructure. I think all of that will get benefit. The one area in tech that might fit the commodity play is obviously semiconductors. The semiconductors are the commodity of technology. And by the way, I'm not by any means saying you couldn't see some growth do well. AI, if those that are the winners in AI could have another big cycle. I mean, this is just the infancy of AI. So I'm not saying you won't have some other areas besides commodities or industrials, but I think generally, you go back to I was there running money back in the late 70s. You go back to then when energy, the Morgan Stanleys of the world had, 50 oil analysts, because they were trying to, they're doing a lot of investment banking. You had Petroleum Helicopter was a company, just a little company that ran the helicopter business out to the oil rigs. it became a growth stock because of that. I mean, so just like this cycle, a lot of little tech became, a lot of AI and other tech became, big investment banking themes, et cetera. In the next cycle, it's going to be energy. It's going to be heavy industry. It's going to be the Caterpillars of the world will be servicing the mining industry, which will be, gangbusters. So there's going to be those kind of things that I think will play. And it's not that they didn't play some this cycle, but it's going to be a whole, they're going to be the leaders.
Indeed, makes a lot of sense, David. And as we head towards the kind of the second part of the interview, about 45 minutes to an hour, we got gold upcoming, a little more on AI, a little bit about Warren Buffett, and I promise some election and geopolitical issues. Sorry, Europe, you are going to get thrown under the Angelo bus and maybe David's as well, but we'll get to that. Normally about this point in my program, someone's got to pay the bills. We have a sponsor read live. This time, I'm it, partially due to David has a great audience and a lot of them don't know me. So a little bit of context. I love doing these interviews. Yes, I'm a single family office that's very narrow guy. I've been doing it for a long, long time, mainly known as the founder and longtime CEO at Family Office Association. I had a liquidity event. I retired. I invest my own capital and I'm a pretty aggressive allocator. Some things I do right, some things I do wrong. I have a lot to learn. But I love doing my interviews. I'm lucky to have a great Rolodex. I know amazing families. I get great insight and opportunity for guests. I love a lot of the podcasts that you all listen to as well. I think Rogan is great. Chris Williamson, Tom Bilyeu, Brett Weinstein, and others. They're awesome. And I learn so much by them. But I do believe my perspective on especially the $100 million plus family and then tying in sensitive areas around geopolitics and others, at least in the family office world, makes me unique. So I do have a fair amount of free content, simply going to LinkedIn and YouTube. I have 2 platforms on YouTube. They're both a little different, at Family Office and at Family Office TV. And I'm moderately active on X, not as active as I would like to be, but those are all platforms where you could go and follow. I have incredible guests in the past, but upcoming. There is going to be more and more content that is going to be even more exclusive for my members. I run a private club of family offices. Selectively, we have a couple of spots available. Go to angelorobles.com. That's my website, angelorobles.com, and learn more. Opportunities, digital and in person, over 100 a year, and the opportunity to interact and be connected. And my experiences and best practices in the family office industry for a long time, kind of connecting the dots and helping you along the way. So even more and more of our soon-to-be content is going to be a little more off the grid and exclusive. That doesn't mean I'm not going to do anything not on some of the more public platforms, of course, just not as much as I've been doing. And that's a little bit of an impetus for, again, going to angelorobles.com and becoming a member. I promise it will be worth a multiple of what you would pay for it. On that note, David, let's get right into it. I promise gold. So do the powers that be suppress the price of gold? And now I'm going to be a little devious again. Once it hits a certain point, although it's going up, are the Eastern Bloc central banks then going to take some of the whatever they're doing or someone's doing to suppress it, and then boom, of course, when they own it at a relatively good price, it now goes up to $5,000 or $10,000 an ounce?
Yeah, I don't know. I'm not in that camp because I have to remind you, gold's at all-time highs. So if they've suppressed, they haven't done a great job of suppressing. And frankly, people jump on, the skimmers, the guys that got caught, skimming for pennies, the traders that did that. And people just hear that they were, sentenced for manipulation. And all they hear is that word manipulation. They say, see, gold's been manipulated. I go, that's not the manipulation you're thinking of, though. You're thinking that the reason my gold isn't at $5,000 is because of the manipulators, not that. So, I don't know. I think so much of what's out there on social media about manipulation of precious metals, and silver gets a lot more of it because it's been the laggard.
Of course.
I think it has more to do with the impatience of the investor today. It did disappoint. It disappointed me back in, but I explained in 2022, it was ready to take off, and then Russia invaded Ukraine and the dollar went through the roof and gold went the other way. People don't understand that. They just understand that they were told gold was going to go higher and it went lower by a lot. So I think a lot of times people want an excuse or want to think a conspiracy behind the fact that they're not getting what they thought they were going to get. So I'm not a big believer that it's manipulated, although I do understand that, the big banks may have an axe to grind in terms of, they've got shorts in there and they don't want these things moving up on them. So I'm not, let me put it this way, I'm not a guy with any kind of information that is worthwhile on that front.
But the opportunity of doubling and then being at the moment above $5,000 an ounce, I get the impression that you don't think that's going to take 10 years. That will happen sooner rather than later.
Yeah, like I said, I think we get the 3,400 probably in the first quarter of next year, and we'll be well on our way there in the fourth quarter of this year. And then I think in the bust, most assets are going to go down, including the metals. So I think gold could go down to, maybe it gets back to its breakout level at 21,200. So if you're at 3,400, you go back down there, you're probably talking it down a third or more. And silver, much more volatile than that. If it goes to 75 in that same time frame by first quarter next year, it might come all the way back here. You might lose 75% of your money before you take off again. So I don't know that. Maybe it's 50%, but it'll be more volatile than gold. But then on the other side of the bust, I think silver and gold will be, but from the beginning of the next cycle to the end of the next cycle, I think it will be the leading performer group. So precious metals.
And broadly speaking, David, and I know you don't want to give investment recommendations, so I'm not going to couch it that way, but should families of great wealth and resources, dynastic families around the world, should own physical gold? Now, others like Warren are going to state it could be cumbersome. How you're going to custody it? There's some level of risk. It's not producing any income. He's not incorrect on any of that. So sure, should gold be 80% of your portfolio in a physical asset if you're a billion-dollar family? Probably not. But should it be 3 to 5%? Should it be something greater than nothing?
Yeah, I certainly think it makes sense to have physical gold, but I also think more than that question, it's really gold and silver. I could predict this probably better than predicting the melt up or the bust. That next cycle, if I'm right about the prices of gold and silver, I can promise you institutions are going to be in with both feet at some point.
Yes,
they won't be in there at the bottom. They won't be in there in a big way early on. By the time you get to the top, they'll be in there in a very big way, just like they are very big in NVIDIA today. They didn't get into NVIDIA at the bottom. They got into the last year of it, or last year and a half of it. So that's the way psychology works, is at the top, people are all in. Well, institutions are the same way. So they may not have hardly any silver or gold today, and I don't care whether it's physical or miners or, playing some of the ETFs, but they will be big players in the next cycle. So this, getting in early and just staying with it instead of trying to trade in and out is probably going to behoove people. It's going to be a big cycle, and the earlier you're in, the more you can capture.
In the context of gold mining investments, do you see gold miners providing a superior risk-adjusted return compared to physical gold ownership? And how should those investors, weigh operational risk against potential outsized gains?
Yeah, the miners, particularly the silver miners, but the miners in general, have not made themselves look very good for a long time. I mean, miners have lagged the metals in a big way. And, I don't think they're the best managed industry. But I will say that with the kind of prices that I think are coming, as I said, 20,000 in gold and 500 in silver, even an idiot is going to make money as a miner in that kind of an environment. And they'll make money here in the earlier period here too, if gold goes to 3,000 plus and silver goes above 50. So a lot of it is that mining is a tough industry. Oftentimes the mines are in places that are unfriendly and places where the governments want to take a chunk, if not all of it. So, there's risks involved with mining. And it's also, as we go along, it's harder and harder to find the economical gold and silver, where you can mine it for a reasonable price. So those things are all factors. But the beauty is that I think we're going to have this long, huge price cycle that means you can afford to go to those areas where it's not as economically viable. You will be able to open up mines that previously you couldn't because it was too expensive. So there'll be plenty of opportunities, new IPOs, et cetera, in the mining industry. You're going to see a lot of merger and acquisition, I think, in that field. And again, that's been pretty absent for a while, even though they're flat on their back and that should be a good time to buy. These companies are just trying to survive. So I think that's about to change.
David, how should significant investors, and there's been many elections around the world this year, we're September of 2024, our election here in the U.S. presidential is in November. Should they be tactical leading into the election? And in what way?
Okay, I have a very, we can get into it. I have a pretty strong feeling about, the election and who's running, et cetera, and what's going on. That being said, my forecast is basically agnostic in terms of who wins, except for from a country standpoint, there's a big difference in policy and all of that. But in terms of the melt up, the bust, and the inflation cycle, it doesn't matter whether it's Trump or Kamala. I think we're looking at the same scenario. So ironically, the election is not a big factor in my forecast. That being said, there's no hedge in me in terms of who's the better candidate for this country, and their policies are 180 degrees different. One is very pro-capitalist, one is very anti-American. I'll say it that clearly.
Oh, trust me, David, those questions are coming. What sacred cow of investing is no longer true?
Sure. You got me on that one. I'm not sure my mind's going to where you're asking. I mean, I will say, I think more in terms of macro standpoint. And so bonds are in their last inning. It's just bonds was always a constant in portfolios. And, going forward, other than government bonds have another year to go because of the bust. Corporate bonds, their game's going to be over this year probably. And from there, it's all downhill because you've got both credit risk and interest rate risk going forward. Credit risk in the bust, and then big interest rate risk in the inflation cycle. So, I think corporate bonds is an area that has been obviously a big part of portfolios for a long time that I don't think should be, after the bust.
Are the big tech companies, Amazon, Meta, Alphabet, are they too big to fail?
It's a tricky question because you wanna compete in the globe, right? They're companies that are worldwide and are part of the reason this country is doing so well. Sure. On the other hand, they're not necessarily have the best, our best interest in mind a lot of the time. and are working at cross purposes with our democratic republic. I I don't I don't I think they could be broken up. Maybe certainly Google's. Some of the things you're seeing and hearing about the slants that you're seeing in search, and then when you ask a question in of Alexa or AI, and it comes back that they won't give you a positive opinion on Trump. They say we don't have an opinion, and then they go give you a glowing opinion on Kamala. Something's wrong. I mean, you've got companies that feel like they're untouchables. So from a political standpoint, I think they're maybe too big, not too big to fail.
David, what does Warren Buffett know that we don't, selling out of a massive position inside of Apple and kind of hoarding, at least for now, the cash?
Yeah, he's keep in mind, Warren's he'll swear off being a macro guy, but he's not stupid. He looks at big picture in a way that he has to because of the role he has, the money he has. But ultimately, I think he's kind of like so many others, and particularly being a value investor, maybe more so than many of the institutional investors, in looking and saying, this thing can't go a lot higher. Valuations are at all-time highs, or valuations are historically high. I think it's as simple as that he's hedging his bets and saying, I think tech's had a great run. I think Apple's had a great run. I got to take some off the table because, I don't see how valuations can go a lot higher. Now, my view of 7,000 on the S&P and 24,000 on the NASDAQ and saying that those might be low numbers, that's not saying that they aren't going to be overvalued. I'm saying that we're in a, maybe irrational exuberance, but we're in a period where I see the potential here for an easing cycle beginning, institutional investment community who's fought this all the way up, who is defensively postured, who is, whether that be in cash or in defensive stocks or in bonds, who is going to feel the pressure when the market's moving away from not by 5%, but by 15, 20, 30%. They're going to have to jump in with both feet. And so it doesn't mean it's justified on a Warren Buffett valuation basis, but I don't care about that. I'm just forecasting the market. I'm not forecasting whether it makes sense or not.
Of course. I got about 4 investment questions. We'll go a little quick round robin because apparently the audience is really wanting for me to get to some society and geopolitical, bringing it into the macro picture. We touched on it a little earlier, and it could be complex. And I'm asking for relatively a concise answer. Good luck. Is the carry trade unwind a systemic risk to the markets that is currently kind of being a little bit ignored?
My take is, and I'm not close to it, but my take is that you had the panic carry trade unwind on August 5th, and then you had the yen back off for, several weeks. So those that were not in a position where they had to panic or who were maybe a little more calm of mind had plenty of time in the next few weeks to unwind gradually. Stock market moved up, the yen moved down. So I think most of that carry trade unwind has occurred. I don't think there's any panic carry trade unwind ahead. I do think Japan's a problem. I mean, I have, by the way, a 0.0085. I do it, not everybody else does it, the dollar yen. I do the yen dollar, and I have it at 0.0085 up from 0.7 or wherever it is, at 0.007. So I do think there's still a good run in the yen this year. I do think that ultimately Japan's going to be a big part of the bust in that You can't monetize the way they've monetized for year after year after year and driven their currency down, and not at some point have rates break out and not have high risk there. So I think Japan's a potential risk. I don't know that it's necessarily a carry trade for other countries. I mean, it may be a Japan carry trade issue, where they've got issues in their own country from all the debt and the fact that the central bank has done what it's done. But I don't think carry trade is a real big issue going forward.
And Jack is asking a question that I think you kind of answered, but if you wanted to summarize it, I will ask it more formally. Do you think the yield curve will steepen after the Fed cuts interest rates, and what will be the impact on the markets?
Yeah, because I believe, we may be in recession already, and if we aren't, we're going to be next year. I believe this is the start of a big easing cycle. I believe the Fed is way behind the curve, which means that over the course of the next year, you're going to take the Fed funds rate down from 5.4 or 5, wherever it is, down to 0, and maybe negative. You're going to take the 10-year, as I said, down to 0 next year, and probably sometime later next year, not in the first half, certainly. You're going to see short rates negative. So it will be a very positive yield curve, but it won't be in the way people think. It's not going to be all, it'll be from deep negative to less negative, or deep negative to 0. The long bond might get down to a quarter or a half, so that will yield something. But below the long bond, I'm not sure there's much. And then, obviously, the credit spreads are going to widen dramatically.
Yes. David, is there a possibility, and I'm thinking that things could be bifurcated in the sense of some stocks like NVIDIA and Broadcom on chips is already largely priced in, even in a bubble, but companies that are largely unknown, energy infrastructure, things that are basically funneling and servicing, and the backbone of those AI plays are actually underpriced at the moment.
Yeah, from a long-term standpoint, you're probably right. I'm looking at it for this cycle. From this cycle standpoint, and by the way, the SMH, which is the semiconductor ETF, I think it's around 230, 230. Might correct a little bit more here. You could get down to 220, but I don't think there's a lot of downside. I have a target for the melt up, which is likely this year. It could spill into next year. I will target a 400 for SMH. So I don't think semis are done. We're in a final blow-off mode that will take, semis will still lead the pack or be one of the leaders. But then the bus takes it all the way down. I mean, if I'm looking at the 8% decline in the indexes, you can pretty much assume across the board a lot of things are going to go. Energy, on the other hand, is the opposite for me. I'm looking at, again, just for this cycle, energy to be, and I've been consistent with this for many, many months. I felt energy was going to be a laggard. I have XLE falling to potentially 20 in the bust, and I don't think it has a lot of upside in the melt up. So I think XLE is one of the laggards here in the last stage of the bull market, and then still gets hit pretty hard in the bear market. So the things I think will do well here late are, semis. I think the tech will catch fire again. Nasdaq's going to go to 24,000. So obviously big tech, Amazon, and all those should do well. NVIDIA, I think, can double, maybe. The microns, I'm not supposed to talk individual stocks, so I should be kind of talking the sectors. I think you'll see copper do very well. I think you'll probably see some pretty good, surprising performance in some of the sectors like housing, still home builders. Maybe autos will finally, they've been a big laggard, will finally catch up some. I'm not sure about airlines. The industrials will do very well. XLI, I think, will continue to do very, very well. XLB, which is the materials, I think will do pretty well. And surprisingly, I think XLF financials should do pretty well, including the banks. So in spite of the fact that we may be in recession and the credit's deteriorating, I think soft landing and Fed ease is going to allow us one last hurrah in the sectors like this. And then, like I said, next year they're going to take no prisoners. I think it's all of them go down mostly. The things that'll hold up in the bust will be treasuries, FDIC, and the insurance savings, because the FDIC, with the printing press, the FDIC will get any money they need to meet their liabilities. So as long as you're within the 250 threshold per institution, that'll do fine. And maybe very high quality corporates, but just be careful there.
And it's probably more of a stock picker's question, David, but I'll ask it. Are companies such as Walgreens and Intel value traps or great contrarian plays?
I don't think they probably are worth it this cycle, particularly Intel. They got too many problems, so I don't know what you'll get out of them in the next 3, 4, 5 months. But then they got to weather the storm in the bust. So maybe they'll fall less because they're already down, but it's not an area I would focus on until you get to the other side of the bust, and take a look at them then and see how they came through that. And by the way, I get this. You may have this question about crypto later, but I don't follow crypto. But when I get asked why I don't, I go, I want to see how it holds up in the bust. It's a very new investment. It's got its, people that really follow it and like it, but it hasn't been tested yet. Let's see how it does in the bust. Then maybe we can determine what its long-term standing is.
Yes, I'm going to, if we have time towards the end, I have a question on that. And basically, the big financial institutions like BlackRock and their involvement, and possibly, some would argue, manipulation or government controls that they would want to be advantageous to them. But we'll see if we'll get to that. Someone did ask, David, would the government step in? Well, Camilla certainly would, but okay, that's my snide comment. Would the government step in and put price controls, not only on food that we know that she already has spoken about, but on oil at maybe $200 or $250 a barrel? And by the way, I'm not saying that may not be a good thing. I'm just throwing it out there.
I can probably answer it better from the standpoint of should she? Yeah, we know she should. Again, we don't know who's going to win. If she wins, I certainly think that's a real possibility. I don't think you'll even sniff that under a Trump administration. So it'd be a terrible thing to do. I lived through the price controls in the early 70s as an investor, and it's a stupid thing. It doesn't work. So hopefully they don't. But I would say she'd be very tempted to do that if she's president.
And okay, audience, a little bit of fun with some interesting questions that I don't think David has been asked as much in the past or the recent past. And we're going to go down some interesting areas. And in my opinion, and maybe with some of the people that many of you listen to, these questions are really not that unusual. But I promise you, in the family office world, that plays it very safe, very down the middle. Often people don't know what they don't know, or simply they're afraid. So I do take certain risks. I do go a little bit more out there. I try to have deep intellectual conversations that are more than just superficial. And that goes back to whether you like me or not, I don't care. If you feel that myself, my knowledge, my guests provide value, go and subscribe to our platform. And yes, even if you don't like me, join and be a part of the amazing network that I've built at SFO Continuity. That's the name of my private club at angelorobles.com. David, I do have to ask, and you hinted at this first one about 15 minutes ago. Here I go. Zuckerberg admits the government forced his censorship of real news. But I'm not done, David. France arrests the founder, Pavel, of Telegram for not sharing private citizens' data. I'm still not done. Brazil bans X for not censoring and limiting political quote-unquote opponents. The UK is arresting citizens for free speech, threatening that they want to come to the US. and do the same to U.S. citizens. What the hell is going on in the world, and why is too large of a percentage of the population acquiescing and accepting the lack of freedoms and free speech?
I'll answer it with 3 letters, NWO. Basically,
we really want to get us in trouble now and get the interview banned on the platforms.
No, basically, I do really feel that we are looking at around the world an effort to move away from sovereignty, to move towards a one world government, and a lot of the banning of speech is in one direction. Obviously, we're taking away freedoms. We're moving away from the free capitalistic approach to certainly in America and other places too. And fortunately, you got some pretty strong people pushing back, like Elon Musk, but it's a battle because there's a lot of forces out there working against us.
Oh, that Elon is coming up. So the greatest danger to the state, or if you want to call it the deep state, is independent intellectual criticism. And by the way, it's not that I'm Mr. Conservative. Maybe like David, I have voted for Democrats. I have voted for Republicans. I'm probably more of an independent libertarian. On certain things socially, I'm actually probably more of what some would describe as a 90s liberal. But on things relative to government, taxation, and what I deem to be a lack of free markets and capitalism, I greatly want freedom. If it means I make less money, if it means I have certain constraints, but I have freedom, to me, that's very important. But it may not be that way to you, and you need to vote however you want to vote. I would just add, be very careful, especially the young ones out there. Don't be manipulated. You don't need the state to provide you, the government, a level of safety and security. You want to have the meritocracy of going out there and building something, no matter what you are. I'm half minority, I'm half Puerto Rican. I wish I was 6'3", I'm not. I wish I was this, I'm not. I adapt to my capabilities. I move forward by learning a craft and a skill, my meritocracy, and I have the discipline and the ability to dream big. Am I lucky that I was born in the U.S.? Absolutely. Do we have a lot of problems here? Oh my God. But as I travel around the world, many of you, and I kind of took some stabs there at Europe with what France is doing in the UK with limiting freedom, is 3 times, if not more, as bad than we're seeing here in the US. But could we trend in that direction? That is my fear. And again, I value freedom, me personally, more than anything else. Okay, David, I'm going to get off my soapbox, but I'm not finished down that theme yet. So France's decision to arrest the founder of Telegram, who may not be a great guy, by the way, there may be some concerns there, but it's not in their position to, in my opinion, to be able to do that. Here's what I'm concerned about. And you mentioned his name, not even born in America, but a citizen, the incredible entrepreneur that is Elon Musk. And whether you like him or not, who cares? How could you deny he's not an incredible entrepreneur doing amazing things? But do you see a future, and maybe not too distant future, where someone like Elon could be arrested?
Well, certainly, there's a lot of possibilities given that, frankly, we've had the front runner in the election almost assassinated twice in 2 months. So, anything's possible, and that's in America. That's in the United States, not overseas. So, I don't think that's likely in the near future, but, I just think people need to understand what's going on. And frankly, and you didn't ask this one, but, it's really not a Democrat versus Republican race. It's a populist versus establishment race. You've got pretty much, look at the people endorsing Kamala from the right. You have Dick Cheney, for heaven's sakes. You got, I think Bush basically, and all the Bushies, all the Bush.
Well, they hate Trump.
They hate Trump, right. And,
right.
But But I think what you're seeing, if people open their eyes and look, the establishment basically does, in fears that if Trump gets in there, a lot of stuff's going to get uncovered. I mean, he's pretty much said, I'm going after the deep state. I'm going in there and I'm going to drain the swamp. And the first time I didn't know what I was doing. I came in from the outside and I trusted people and I shouldn't have, et cetera. I think he's much more prepared this time to go in there. And the reason he chose J.D. Vance is because he's the heir apparent of the populist movement. The Republican Party is not the Republican Party of the past. It's not a Wall Street Republican Party. This is the populist party. It's more akin to the blue dog Democrat that Reagan attracted. It's understanding that we hollowed out our economy. And I grew up in going to college in the late 60s, early 70s. We were all taught, and I think ever since, the whole comparative economics thing, and I took a lot of economics courses. The whole comparative economics globalist idea that you farm out the things that other countries can do, and you just do what you do best, and you keep moving towards higher end stuff. Unfortunately, globalism didn't benefit the way it was supposed to benefit, and now we're looking. I mean, just look at pharmaceuticals, for example. During the pandemic, we didn't have control of our own destiny. China owned most of the supplies we needed. So, and the same thing, steel. Well, we don't have the steel today. If we ever had to go through a World War II build out, we don't have the things here to do that. We don't have the various minerals and metals to do things. So I think what Trump is doing and what J.D. Vance is also pushing is this idea we got to get back to an industrial base. We've got to get away from just being a service economy. We've got to reshore a lot of these companies and industries that we let just go away. We got to protect, not from a protection standpoint per se, although tariffs are a part of the agenda, but we got to get our auto industry back to being a leading industry again. There's a lot of things. I think basically, if you look at the last 30 or 40 years, Washington's basically gone, it's allowed a lot of things to go out of this country, and we're trying to get it back to where it was and and it's also benefited the top 10 or 20% of the population, while the bottom, really had nothing. So, and what the alternative is, what the Democrats are offering is a government solution. Everything is, we'll give you more money so you can have a down payment for your house. We'll give you more money so you have childcare. We'll give you, we'll do away with private insurance so you can get Medicare type insurance. What nobody's understanding is the government's the least efficient way to do these things, and we want to move everything towards socialism in government. I mean, it just doesn't make sense. But the Democrats have a huge advantage because they have the media in their pocket. The media is their communication arm.
And they have the Hollywood, the media, tech, and I wouldn't have said this 20 years ago, but probably at least half of Wall Street.
It's very, very lucky.
It's the Republicans are fighting an uphill battle. Now, part of that relates to, are they reaching the masses? Are they reaching the young people? Could Republicans have done a better job? Of course. Is Trump a man of impeccable character? Probably not. But I need to make a decision, in my perspective, voting, overlooking certain things relative to character. And they both may have character flaws, but realizing who's going to be the better option for the country. And I don't know if you go to Europe relatively frequently. I do. I love it. I love the people, the architecture, the food, the nuances of each country, the culture, at least that it used to have in many of these countries, and the talent of the engineering people there is amazing. That being said, for many of the reasons that I noted, and I know it sounds like I'm really going hard on France here, maybe I misheard it, but a company in France, you're not allowed to email an employee after 5 p.m. I know some of you are going to come at me with work-life balance. It's bullshit. You've been lied to. You have to work hard when you're young and smart. Some of you will make it, some of you won't. That's just the reality of how it is. But I do know if you think that you could be an entrepreneur and you could build greatness to the company working some sort of 9 to 5, I don't get it. And you look at things happening in Europe relative to bureaucracy, how slow things are, how comfortable the state makes people feel, what you mentioned indirectly earlier, David, censorship, declining birth rates like you wouldn't believe, and yes, I know it's sensitive, but a loss of their culture. I see things that probably are going to be very difficult to turn around there. Name me a company in Europe in the last 40 years, so newer, the last 40 years, that made it into the Fortune 500. I think there's a couple, and maybe next year Stripe, maybe Anthropic and AI, and great, I want to see more of that. What I'm saying, though, is there's a lack of an entrepreneurial focus of the state and the governments, not the people. I think they want to, many of them want to do the right thing and want to do that and want to stay there. Yet constantly, many of those countries make mistake after mistake after mistake. And that appears to be, although we're not as bad yet, creeping more and more into the U.S.
That's simply socialism is what you're describing. And unfortunately, I mean, really, we're forgetting what got us here. You know, we've really kind of killed the golden goose. And yes, we're still relative to the world doing okay, but that's not going to last. And frankly, I don't think people realize where we're going in this world. You know, if people are worried that they should have more leisure time or whatever, I described, you know, I said this next year is going to be a rough time to bust. What comes in the 30s, I describe it this way. I go, it's far enough out there that I could be dead wrong, but based on that inflation cycle I described and the inability, and this is, again, I'm using U.S. as the example, but this is going to be pretty much parallels across the globe, that you're going to have such high interest rates and such high debt levels in these sovereign debt areas in the countries that they're not going to be able to fund their governments. They're not going to be able to service their debt or fund their governments. I can envision a scenario, again, somewhere 2033 to 35 in that period, where in the U.S., we have 50% plus unemployment, a government that's bankrupt with no welfare system, no unemployment, limited Social Security and Medicare, if any, and go down the list of other things that government provides. I don't think people realize the world we're heading into, because we've had this great run from the Great Depression till now. It's coming to an end, people, because we're pissing away, $7 trillion under Trump, and most of that was because of the pandemic, but then another $8 trillion under Biden in terms of these programs that aren't being, nobody's auditing them or accounting for where the money's gone. It's criminal. This money is going out there, and what do we have to show for it? Climate change is just redistribution of income, but it's not redistributed to the poor. It's redistributed to the government class. I mean, we're watching this stuff. If you think in the mid-2030s that climate change is going to be anything anybody's concerned about when they're trying to put food on their table, trying to just survive, climate change is just a waste of money. And most of it's probably really climate driven by sunspots and other things. It's outside of the realm of what they're fighting. So we have an entire generation, because of the way we've dumbed down the schools, that has grown up to do the dirty work for these socialists that are out there playing a game. I mean, and they're laughing all the way to the bank while we're all basically trying to make this thing work. So I hate to go off on a soapbox like that, but I don't think people realize what...
Well, I've done my share. David, maybe just a couple of quick questions to wrap it up. is Trump running against Harris, or is he really running against a system that requires a candidate that they could control, which means having original ideas is disqualified? And as we've seen now twice in the last 2 or so months, might even get you whacked.
Yeah, I saw, and I don't remember who the source was, but it was a legitimate, political scientist type source, but talked about, if you really understood the history, that no president has been elected in this country before Trump that wasn't basically blessed, that they, whether it's Bilderberg or who it is that's controlling things in the world, that basically Democrat and Republican alike, that nobody got into that office without it being, basically blessed by people. And that Trump surprised everybody in 2016 and won and wasn't supposed to. And so that's why they're fighting so hard. They don't want him back there again because he is not one of those. The others, whether you're a Democrat or a Republican, whether you're on the left or you're on the right, basically, I don't know whether it's the banks that ran it or, global elitists, or you want to say ran it or what. But there's a system behind the scenes that basically said, yeah, these guys are acceptable, these guys aren't. And Trump's defying those odds. And, he basically turned the Republican Party over. This MAGA group, which is half the country, is a populist movement. We've always seen these big movements in the country, once every 100 years or whatever. And this is one. And I think, again, if they don't cheat their way into office or don't assassinate their way into office, Trump's likely to be the next president. But those are big ifs.
Does war, and it may be more of a history question, David, does war ever happen during non-inflationary periods?
So, I don't know. War can cause the inflation. I don't know my history well enough. I'd have to think about that in terms of it. But certainly, war is typically what we've seen is more often than not is a way to get out of a problem. And sometimes to get out of a depression, as you saw in World War II. So I'm not sure whether it's response to inflation or whether it causes the inflation.
You mentioned it earlier. I'm not even the one who brought up Bitcoin. It was David, I promise. BlackRock says Bitcoin could be, wink, wink, a hedge against increasing global disorder and declining trust in the government, banks, and fiat currencies. Okay, they might be right. In some ways, I hope they are. But again, everyone think for yourself. This is BlackRock here, now with the spot ETF, now having tons and tons of people involved in the world of crypto, Web3, and Bitcoin. Is this statement somewhat conflicted because they're going to profit from areas that could be done, including manipulation? Why else would they say that? It seems a little out of left field.
Yeah, I just find, when you look at the energy required for Bitcoin, when you look at, I get the attraction that it does get you outside of central banking, and certainly, there's a big chunk of the population that it feels like that's a necessity. The problem is Bitcoin's still a very small piece of the global pie, very small piece of the macro pie. That's one reason why I just don't pay much attention to it. And my feeling is when you describe a global bust and then a huge hyperinflationary recovery and then a collapse of the system, I see if Bitcoin survives all that, it's there to benefit a very small number. It's not going to be a solution for what's coming, in my opinion. So I just don't see it worth my while to really spend a lot of time. And frankly, I've not been overly impressed with the people around crypto and around Bitcoin in terms of a lot of them are old hedge fund guys that failed at equities and all of a sudden saw a new game in town that they could pump. So and that's what I see, a lot of pumping. So I'm the first one to say I'm not a follower of Bitcoin, so my opinion is probably worth less than nothing. But that doesn't mean I won't tell you what I think.
And I believe my last question for David, will uranium also have a massive bull run in the commodity super cycle that you envision?
It certainly makes sense that it should. I mean, I have not been a follower of uranium this cycle, and I know people tried to pump it and they did the opposite. So there's a lot of disillusion out there, I think, about it. But when you look at who never thought you'd see it in this country, but you have this country realize that nuclear power is got to be resurrected, and that they are resurrecting some of the old plants, and they're figuring out new technology to build smaller nuclear plants, much quicker and all of that. And then you look at where the world's going, proliferation of nuclear, I think, is unfortunately going to be the future, not the opposite. So I think uranium's going to be in the next cycle, probably along with the rest of the commodities at play.
And maybe a broad comment into a question, which could be your final comment, David. And I get it. Every family and family office is different. We don't have a crystal ball. We don't exactly know how things are going to play out. I'm a big advocate that AI is going to get incredibly better and better and better. It's doubling once every 1.03 years. If that keeps that pace, that's 1,000x within 10 years. I think we will hit before the end of this decade AGI. And I think inevitably we're going to hit what some would call super intelligence probably within the next 6 to 10 years. And that's going to change everything, I think, from an economic, from an energy, and from a variety of different perspectives, including government and military. It may help with a utopia. It may also bring upon greater dystopia and challenges moving forward. So I have to place the question to you, with all that is happening around the world, given that my focus is on family offices, specifically single family offices. So again, those are the richest of the rich. They supposedly have political influence. They can impact their communities. They have lots of money for philanthropy to also be of value. And you mentioned, let's not forget about those that have been left behind. There's not going to be a country or countries or the quote-unquote super rich if there's massive uprisings. I hate to go back to history, but look at the Russian Revolution. Look at the French Revolution. What do you think happens outside of the royals to the super rich? They're no longer super rich. It gets taken from them or they're placed 6 feet under. So the reality is it is a problem. We do have to address it. And that may be one area where I do have a little disagreement with those maybe on the far right, that we can't ignore those that are being left behind. How could we help them help themselves? And how could we as families be in position to provide value back through our philanthropic dollars and teaching what we learned? Why don't I give you a chance, maybe, before I give you a chance to share your info and how people could subscribe to your services and reach out to you, speaking to the super rich, the family offices, and concluding our conversation, what's a message you would like to get out to them?
Yeah, I mean, I'm certainly with you, and I don't want to ever make it sound like I think the rich should be able to do whatever they want, and the poor, good luck. My problem is with the economics of it in terms of, I'll get back to your question, but, so-called trickle down or supply side economics, unfortunately, I don't know whether it was a political, whether they use politics to do it, whether they felt, we want to make sure people still don't understand, that's a good thing. But frankly, you do benefit when you cut taxes. You do benefit when you spend less government and do more in the private enterprise. So I do think that the lowest part of the population structure, the lowest part of the economy, gets lifted more than anybody percentage-wise when you do supply side, when you do those things, when you get away from a socialistic approach where government can do everything. Because the government is, basically it's a libertarian view that the more you give government, the more you're going to regret it. So from that standpoint, that's where I come from. From the wealthy, I mean, there are, as you well know, Robin Hood and some of those, there are, and certainly Warren Buffett is giving away his wealth, and, Leon Cooperman's giving away his wealth. So there's plenty of good examples of wealthy people who aren't turning their back on the poor and really do want to help them. My problem is we're doing it the wrong way. I mean, I think the wealthy should be using their voices more to get back to a capitalistic approach to raising, lifting all boats, letting the tide come in. We've gotten away from it. We've allowed the people with the most economic ignorance to drive the bus. I mean, the left has no idea how economics work, how the economy works. Yeah, that's what seems to be dominating how we are. And as you said before, probably more than 50% of Wall Street is now Democrat. How can you be on Wall Street and not understand that those policies are absolutely counterproductive?
You're preaching to the choir, that's for sure. For those that would like to learn more about how to follow you on X, which is your Twitter, that's your dominant platform, and so what would be your handle, and how could they learn to subscribe to any of your services, newsletters, blogs, etc.?
Yeah, after my loose cannon interview share.
I get the best out of you, David.
Maybe I'll get one or two. But they can follow me on X at Dave H. Contrarian. So it's not David, it's at Dave H. Contrarian. And I'm there every day. I get people who've been longtime followers who all of a sudden go, "Where have you been? I haven't seen you in months." I'll go, "I'm on there every day." I probably answer dozens of questions a day, and except I do it through replies. I very rarely do original tweets anymore because, I get such a cascade of answers. It'd take me all day to go through everything when I did that. So mostly it's replies, and if your settings aren't set up to get the replies, it'll look like I'm not active, but I'm very active on there every day. And then I put out a quarterly investment letter, a macro letter that I've been publishing since the year 2000. So it's 24 years now. It's quarterly. It's basically markets, the economy. It's all the macro stuff, dollar, etc. And if anybody has interest, it's by subscription, so there's a cost to it. All they have to do is just direct message me on Twitter or on X, and I'll give you details.
Excellent. I'm a big fan of David Hunter. I always enjoy my extended conversations with him. I learned so much. At the end of the day, even decade after decade in geopolitics, economics, investing, and to me, how it circles back to my love and obsession with the single-family office community, I still want to have the mindset of being a white belt and having so much to learn, which apparently I do. And hopefully sometimes I'm open-minded enough to be able to learn. My close, I kind of gave it both in leading into David's close with some perspectives that I would have, that I hope some of you enjoyed listening to, and the breadth of my questions. And I kind of gave my infomercial about an hour or so or halfway through. But again, definitely go to X, go to LinkedIn. You'll find me, Angelo Robles, follow me. And my core platforms are two of them, which I know is probably confusing, but at Family Office and at Family Office TV on YouTube. I do have a new Rumble, just in case. Can't hurt to go and find me and follow me there. And it's a little old school, but I revived my Apple and Spotify more listening podcasts. Some of you mentioned you drive a lot, and it simply is a better platform for you to listen. So I'm Angelo Robles Podcast. Nothing to hurt. You might as well go and follow me there. Again, I'm not in it to be liked. It's okay to even be disagreeable or disliked, as long as I'm helping you think for yourself. Think of questions you should be asking, and more importantly than anything, was that's too focused on me, the quality of my guest. Like David. David mentioned Leon Cooperman. I had Leon on for a good hour and 10 minutes, probably the longest interview that he's done, about 4 to 5 months ago. And it's up on my platform so you could find it. And he is a wonderful man and a great philanthropist. So I have great guests. I've been very fortunate. I believe Michael Saylor's coming back on. It's been years. So speaking of Bitcoin, and just so many different topics around geopolitics, economics, and investing, and of course, single family offices. So go to angelorobles.com and rather bluntly, yeah, you should see the value in my network, connecting the dots, and the value in my proprietary private programming, and simply join my private membership group at SFO Continuity. That is where you're thrust in with peers that are incredible and so much to learn from them and the interaction with them. So again, I hope you all enjoy this. This is mid-September of 2024. Maybe you roll this forward 3 months from now, 6 months from now, a year from now. I'm sure some things will be right, some will be wrong, but do understand it's in the context with the information that we have in the time right now. And like I stated earlier, way too many in my community, which makes me a bit of an outcast after being in it for 20 years, creating my own family office and traveling the world consulting and working with families from Africa to the Middle East to Europe. It's been a blast. And I don't mind going down some roads that some would consider a little sensitive. Maybe I go into them, sometimes a bit ignorant, but hopefully I have an opportunity to learn from such incredible people. On that note, I really appreciate all of you. Thank you, David, for being a great guest. I look forward to next time, and enjoy. Say hello to everyone. David, thank you so much for being a guest.
Thank you, Angelo.
Pleasure. Thank you.